Good morning and welcome to this Tuesday, August 15th, 2023 edition of Trading Places Live with earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we figure out what's going on this morning and where we might head later today. Let's take a quick look at futures. This was probably about 10 minutes ago. Dow futures down 268 points, S&P 500 futures down 27. NASDAQ futures down 79. On a percentage basis, got a little bit more selling in the Dow and the S&P, less in the NASDAQ. Crude oil prices down about $1 this morning. That's a little more than 1%, back to about 81.5 per barrel. Recently, we got up above that $83 a barrel level, which was rather significant technically, because going back, that was the high of 2023. And this pullback now, we'll see if some key moving averages hold. But at least in the near term, crude oil back down below that key $83 a barrel level. The U.S. 10-year Treasury yield up another 5 basis points this morning, 4.23%. Probably no relief in sight for those mortgage rates if you're looking to buy or maybe thinking about buying. Not getting any cheaper, at least right now. I do think they will come down later in the year. But of course, I've been saying that for a while, and they've been pretty resilient staying up. I think this morning we'll talk a little bit, but the retail sales number came in a little bit hotter than expected for July. And I think that's probably one of the reasons why we're seeing that 10-year Treasury yield up again this morning. Let's go ahead and jump into the action from Monday. So the Dow Jones Industrial Average finished up $26 points. The S&P 500 was up about 25 points. On a percentage basis, though, that's a pretty big difference. The S&P was up almost 0.6%, whereas the Dow was up less than 0.1%, simply because of the size of the indexes. The NASDAQ 100 up 177 points. That was over 1%, almost 1.2%. Meanwhile, mid-caps were up just barely 0.16%. They were up just 4 points, and small caps were down for the day. They were down. The IWM, the Russell 2000, was down about 33 cents, which was just slightly below 0.2%. But they did come well off the lows from earlier in the day, and also came at a time when we were hitting some key support right around that 188 level. I think 188.40 might be the level to watch. I'm watching any kind of a close below 188. I would not be happy with that. And technically, I think short term, that's a breakdown. You want to be careful. Doesn't mean you can't go below 188 and come right back up. Market can do anything at once. But if you use technical analysis to manage risk, which is what I do, I think you got to be really careful if 188 is lost. You can always get back in, even if it's a little bit higher. But what I don't want to do is hold it down to 185, 180, 175. If the market keeps going down, you don't want to stick with it, especially in leveraged ETFs. So something like the TNA that tracks the IWM, which I'm in, I don't want to be in leverage if there's a technical breakdown. I don't make any excuses for that. Transports rose about 41 points yesterday, so it was about 0.25%. Nice hammer on the transports, just above the 20-day moving average. We'll look at that chart here in just a minute or two. Russell 2000, also really nice finish after being below the 50-day moving average, below gap support, and almost down to that key price support around that 188.40 level. We reversed, closed on the high, back above all those levels. So that was a nice finish yesterday on the IWM and really across the overall market. But we find ourselves once again in the morning down and looking maybe for some relief later in the day. Technology led the advance yesterday. That was a good sign. We haven't seen much strength from technology lately. Had a negative divergence in play. We saw that play out all the way down to the 50-day moving average and then some to the downside. Of course, the thing you have to realize, a lot of folks say, well, if it's below the 50-day moving average, it's a big breakdown. Well, it depends. And it depends a lot on the slope of the move to the upside. I mean, if you've had a huge rally to the upside, you're not going to continue that pace for the long term. And if you followed a lot of my work, and I've talked about this a lot, when you reach a bottom in a cyclical bear market, that first year after that that move, or after that final low, that next year is your best return. In fact, it's the majority of your return over the next 2 years is typically within that first year. So, we've had a huge rally in 2023 in technology. And when you go from 125 to over 180 in about 6-7 months, I mean, you're talking about a 50% move. That's unsustainable. That advance, that slope is unsustainable. And when you start to just have more normalized returns, you're going to move below the 50-day moving average, because when prices shoot up like that, so too does the 50-day moving average. So it's not just in 2023, it's really anytime. Anytime you see that big advance like that to the upside, your tendency is to see a little bit more selling when you do finally hit some selling. So I think the key is going to be, I think we're going to sideways consolidate. I can tell you that, let me look at my schedule here, or my spreadsheet. All right. So if you break down the S&P 500 by calendar quarter, so January through March and so forth, and then you break down each of those quarters into halves. So the first half of the first quarter, the second half of the first quarter. So that would be January 1st to February 15th, then February 16th to March 31st, and so forth throughout the year. The period we're about to enter, the half calendar quarter that we're about to enter, August 16th, which is tomorrow, through September 30th. This is the only half calendar quarter since 1950 that has an annualized return that's negative. So if we look at the first half of the first quarter, January 1st to February 15th, the annualized return is 12.49%. And by the way, when I give you these numbers, keep in mind that the S&P 500's annualized return is 9%. So if all these periods were equal, we'd see 9% or roughly 9% each of these half calendar quarters. That's not what we see. First quarter, 12.49%. Second half of the first quarter, 4.8%. It's both positive, but you can see the tendency is that you're going to get that bigger move in the first half of the quarter. Second quarter is even a bigger disparity. So April 1st to May 15th, 13.25%. May 16 to June 30, 1.15%. Think about that for a minute. We're talking about going back to 1950, and this is a month and a half of every year for the last 73 years. You would think that they'd be somewhat closer together. But what this tells me, and what you should be thinking when you're approaching the stock market, is that the stock market, even though Wall Street's always talking about going into earnings season and how earnings are not going to be very good and they're going to be disappointing, we hear it every single quarter. And yet the stock market historically crushes the average return when it's in a period when earnings are approaching. So while CNBC is being flooded by all these analysts going on, talking to us about how earnings are going to be so horrible, the stock market performs its best during those periods. So, yeah, I think there's a little bit of manipulation that takes place. Now, is it intentional? I have no idea. But, I give you facts. This isn't my opinion. These are numbers. These are actual numbers that have taken place since 1950. So let's move on to July 1st through September 30th. So that's your third quarter. July 1st to August 15th. Today's August 15th. July 1st to August 15th, 10.02%. And remember, this is after the go away in May. So keep that in mind. This is a period that actually outperforms the S&P 500 for 6-7 weeks. But you get past August 15th, August 16th to September 30th, minus 4.88%. That's going back 73 years, a month and a half of every year for 73 years. That's a lot of trading days. Then we go into the fourth quarter, and you wonder why I'm always bullish in the fourth quarter. Let me give you the half quarters in the fourth quarter. October 1st to November 15th, 16.24%. November 16th to December 31st, 16.97%. The best half quarter of the year is actually in the second half of the fourth quarter. It's going through the holidays, through the Thanksgiving holidays, through the Christmas holidays, and right up into the new year. And I think folks are just optimistic. They're optimistic. If you've had problems this year, don't worry about them. Don't have to worry about it. You don't have to talk about it anymore, because next year is going to be better. Next year is always going to be better. Next quarter is always going to be better. I love these companies. When I go through, we do a lot of research with earnings. And I love how many times I see companies miss earnings, or maybe just kind of match earnings for the current quarter. Next quarter, they'll kind of throw all the garbage in, basically just get rid of everything that's all the baggage or whatever. The next quarter is going to be bad, but the rest of the year is going to be awesome. Well, you start running out of time when you get into the late part of the third quarter. And I think that's part of what goes on. Once you get past earnings season, August 15th to September 30th, if there's dirty laundry to get rid of, I think most companies come out and get rid of it. And they just finally say, okay, our fourth quarter is going to be horrible too. But next year is going to be delightful. Next year is going to be wonderful. Can't wait. It's going to be the best year we've ever had. That's mostly what happens with these earnings calls, which is why I never listen to them. I look at the charts. I just follow the charts. Some people get really interested in these. To me, it's just a dog and pony show. Just kind of going to bring out all the tricks, all the whistles, bells and whistles. This is what we're going to be doing next year. These are the products we're going to do. This is why we're going to outperform. And then just kind of go through the whole rinse and repeat cycle. It's the companies that continually beat and raise guidance. Those are the ones that you want to really pay attention to. And that's why we have our strong earnings chart list. That's why we have our raised guidance chart list, so that you can make sure that you're aware of the companies that are actually coming through, beating earnings estimates, raising guidance. Those are companies that you really want to pay the most attention to. Anyhow, I always find it fascinating the way the market trades during the year, and especially first half of a quarter versus second half of the quarter. And if you notice, a lot of times, if you look at like the performance of some of the aggressive areas of the market, and you look at March, and you look at June, and you look at September and December, some of those growth areas, some of those really highly aggressive areas don't perform very well. It's because they get the pre-earnings run up, they get the post-earnings run up, and then they go into this period where they just kind of come back down to earth. And we're seeing it a little bit early this year, because we had such a huge run up into earnings in the beginning of July. I mean, you can see across the board, if we look at the sectors down below here on this candle glance that we're looking at, you can see technology. I mean, really most of the quarter, all the way from back at the end of April through June and into the first half of July, had a huge rally. Earnings started coming out, and some of them were good, some of them were just okay, and the market has just been in sell-off mode ever since. Communication services, we had a little bit of a pullback. We're still off the highs, but it hasn't been too bad. Discretionary, pulling back to about the 50-day moving average, trying to kind of get its bearing straight right now. But I'm going to show you the sector relative strength in a little bit. But looking at the absolute charts, I mean, technology, it's a little bit below the 50-day. We got the 20 crossing below the 50. That's going to get a lot of folks bearish. I'm not bearish, because you'll see that a lot of times in a period of consolidation. And that's all I'm expecting here. And I'll show you again why in just a minute. Semiconductors, big day yesterday, up 4%. This is a group that had been struggling mightily, but it was down below the 50. It's come back up. Still got work to do technically. I wouldn't be surprised to see it back down again. When we get back through that 20 and through the 50, start making a move back closer to the recent highs, that'll start maybe to give us a little bit of shape of what kind of a continuation pattern we're looking at. And that's what I'm expecting to form, by the way. Whenever you go through a big advance and you start to sell off, first thing I start doing is looking for continuation patterns. You get a lot of people in the market, very bearish by nature. They see a little breakdown and they're like, okay, here we go to the downside. I look at it as an opportunity to identify a continuation pattern of some sort to the upside, because 9 times out of 10, that's what we're going to see, maybe 19 times out of 20. And so I tend to take the more optimistic view. And as I've said recently, I have no other signals telling me that this market's going lower. Nothing. Even the VIX, when the market, if you take a look at the VIX relative to what the S&P 500 is doing, I think 7 of the last 8 days, the VIX is closed at or near its lows for the day, certainly in the bottom half of the candle. So while we're seeing morning weakness and maybe morning gap ups and movement in the VIX, by the afternoon, a lot of it's being simply cast to the side. And that tells me that this selling is not going to last. Renewable energy up 3% yesterday, also a really strong day. And then the internet group bouncing off that 20-day moving average in very bullish fashion, helping the communication services yesterday. All right. Let's take a look at the 10-year Treasury yield. All right, so we had the, see if I can find it for you. We had the retail sales come out for July. The actual retail sales number rose 0.7%. The market was expecting 0.4%. And if we strip out the vehicles, it rose 1% versus 0.4%. So you can look at this a couple of different ways. When I see a report like this, I think to myself, okay, economy strong, that's good. Retail sales are good. So we still got the consumer on our side. 2/3 of GDP is consumer spending. So it's always nice to see the retail sales doing well. But the flip side is we've been dealing with inflation. And what the Fed has been trying to do is slow the economy. So if you're more interested in the inflation and you think inflation is not done and is going to go higher, then you would probably look at this and say, wow, retail sales coming in double what was expected. And if we strip out the vehicles, more than double, like 2.5 times what was expected. And so that's going to put more pressure on the Fed, maybe to keep raising rates, which we can see the 10-year Treasury yield, which is now off of the earlier high, but still it is up 1.5 basis points, sitting at 4.20%. We got to 4.27 earlier. And this high all the way back here in October of last year was at 4.33%. Now, here's something to think about. Everyone was blaming the rise in interest rates and the inflation pressures as the reason for the market doing what it did in 2022. And I get that. We talked about it early in the year. We expected it. I turned maybe a little bullish, or a lot bullish, more than most folks. But I was looking at some other signals besides just strictly looking at the S&P 500 and the major indices. But I want to ask you this question. We were at 4.33% back in October last year when we were at the bottom on the S&P 500. We were at 3,500. Maybe at this point, maybe we'd rebounded to 3,600. I don't know where we were at that point. But my point is we were down quite a bit. Still, most everyone probably was thinking, hey, this is going to go lower and lower. And rates were going higher and higher. Now, I want you to look at where we are, where we were this morning, 4.27%. Almost exactly where we were back in October. Where's the stock market? We're not at 3,500 anymore. We're at 4,500. What the heck's going on? I mean, if inflation's still a problem and we can see rates still, high, and the Fed still not really saying that they've stopped definitively, why is the stock market rebounding? Well, because we were in a cyclical bear market, not a secular bear market. And so prices just got ahead of themselves. As I've said many times, we went through a 22-month period where the S&P 500 went up 115%, the highest we've seen since all the way back in the 1930s. That's unsustainable. The market can't go up 115% every 2 years. On average, historically, it goes up about 18% every 2 years. So when you go up 115% less than 2 years, you need a period of consolidation. You need a period of selling. We were set up for a cyclical bear market in 2022. That's behind us. And so we've seen that rate of change, the 1 year, the 2 year, the 5 year, all of those rates of changes have come back down. And so we're back down more in normal ranges. And so I think the market just picks up where it left off prior to this cyclical bear market. And we're going to have pullbacks from time to time. We're not going to go up every day, not going to go up every week. As I said, probably the majority of the gains that we're going to see we've seen. I still think we have another big advance coming in the fourth quarter. But after that, I think next year will probably be a little bit calmer, probably a lot calmer in terms of gains on a percentage basis. And we're still too far out to really make any calls for next year. But I think that certainly the worst is way behind us in the market. And my guess is that we don't break out above this 433 level, but it'll probably come down to what the Fed does. And we'll just kind of go along with that. But my point is, if you're fearing a breakout in the 10-year Treasury yield above 433, I just want you to know that we're pretty close to where we were all the way back in October. And the S&P 500 has gone up probably about 28% during that period. So, just kind of think about that for a couple of minutes. All right, S&P 500. So here was the pullback, hit the 20-day. We bounced off of it, which was nice. We're seeing morning weakness again in the futures. Let me see where we are right now. We've come off a little bit, it looks like, the earlier low. Actually, the best way to look at it is just to pull it up. Excuse me. So we've got the Dow Jones now down 0.6%. Spider is down less than 0.5%. The QQQ is down about 0.25%. IWM down a little bit more than 0.5%. We've come back up a little bit off those earlier pre-market lows, and it's probably because the interest rates have reversed back down a little bit. We'll see. But the pattern, I feel like if you ever saw the movie Groundhog Day with Bill Murray, I kind of feel like that every day I wake up in the market is red. We have futures that are down. And then I come on the air the next day and talk about how we rallied back throughout the entire day. If I show you look at the QQQ. And this is a 5-day 10-minute chart. So here's yesterday. But look at this opening gap lower, finish on the highs. It hasn't been exactly perfect with the QQQ because I think we've been seeing a lot of rotation out of the QQQ. But when I pull up the IWM, 4 or 5 days ago, look at the afternoon rally here. Morning weakness, afternoon rally. Morning weakness, afternoon rally. We did sell off a little bit there in the last hour and a half. This was really the big exception. We actually this would have been last Thursday. Yeah, last Thursday, we gapped up, moved up intraday, and then we sold off the rest of the day. Had a little bit of rally in the final 2 hours. But look, then again on Friday, gap down. We finished well off the earlier lows. And then yesterday, you can see the morning weakness and then the gain throughout the rest of the day. This is why this type of behavior is why when we look at the IWM, I'll pull it up relative strength. Look at the AD line right here. The AD line is breaking out to a new high, even though looks like we've been going straight down for 3 weeks. So, and the reason that it's doing this is that we're not seeing a lot. I told you a couple of days ago, I think it was Thursday last week, that was a pretty bearish day. And I would say over the last 2 to 3 weeks. It's the only really bearish day that we've seen since we topped. The day before on Wednesday was a little bit bearish. We did rally, like I said, in the final 2 hours. But look at all these other days. Hollow candles or long tails to the downside, which signals intraday weakness, followed by intraday strength, leaving those lows, those tails way down below. So what you're seeing in price action, if you're just looking at your statement at the end of the day, you're thinking, wow, market's really struggling. But if you're looking at some of the signals on the charts, it's telling me we're going back up. I don't know when. I'm going to keep my stops in play. Hopefully I don't get whipsawed, but I could. And I'll, if I do, I'll get back in at higher price because I think the market eventually is going higher. And I think in the fourth quarter, we're going to go a lot higher. And then, like I said, I think the pace of gains will slow after that. All right, let's keep moving on. Just look at the NASDAQ 100 real quick. We are a bit below the 50-day, or we came back up above it yesterday. I think we're going to go through some sort of this might be a bullish inverse head and shoulder pattern. Left shoulder, neckline, head. Maybe at some point we come back up to about that 15,750 level. One more little pullback, maybe September. And then come the fourth quarter, I think we break out and explode to the upside. That's what I think is going to happen. So again, as we pull back, I'm looking at this as some sort of a continuation pattern, and I'll just wait for it to develop. It could be just that it's a slow move back to the upside. Maybe it's a cup that ends up forming. Maybe we go all the way back up to the high and then come back down in September at some point, and we put in a higher low, and maybe we get some sort of like an ascending triangle. But those are the types of patterns that I'm going to look for to evolve. IWM, there's the move down. There's that big recovery, nice hammer off the 50-day. With weakness this morning, we'll see if maybe we recover off of that. I think watch the interest rates. I think the 10-year Treasury yield comes down. That might be a catalyst to keep yesterday's afternoon strength going. But maybe we go back down one more time. I don't know. Like I said, short term, very difficult to call. Transports, there's that hammer. I told you I'd show you later. Beautiful move down, nice hammer on the the 20-day moving average. We'll see if we can rally off of that. Chart of the day. Let's see. Chart of the day. If you go over to earningsbeats.com, scroll down, you will see an area where you can put in your name and email address so you can subscribe to our Earnings Beats Digest. It's a free newsletter, no credit card required. You can unsubscribe anytime. We have regular emails that come out Monday, Wednesday, and Friday. And then, of course, I'll show you one today here in just a minute. But if you'd like to get these, they're very quick reads. They're just a couple paragraphs in a chart. Could help in your trading. I try to pass along things I've learned over the years that cover a wide variety of topics, but especially earnings, gaps, relative strength, price volume, price support, price resistance, trend lines, those types of things. So what's the chart of the day for today? I'm going to give you a seasonality chart on Nike. So Nike, if you look back over the last 20 years, first of all, you probably realize that over the last 20 years, the worst month of the year is September. But if you go back the last 20 years and you look at the average return for Nike, September is the best month of the year. So the worst month of the year for the S&P 500 over a 20-year period is the best month of the year for Nike over the same 20-year period. That seems kind of strange until you think about it. It's like, maybe it has something to do with back to school, because Nike makes its move starting in September right through the end of the year. I mean, look at the percentage of times the months go higher and look at the average returns. If I come across and I add from January to August, Nike's a great company, been a great company, very profitable over the years, steady earner, steady performer for the most part. If we look back over the last 20 years and add the average monthly returns for the first 8 months of the year, minus 1.1. So I'm just going to do a cumulative as I go across here. So that's plus 0.4, 1.4, 2.2, 2.1, 3.3, 5.1, 5. So the average return for Nike, January through August, is about 5% going back the last 20 years. From September to December, however, it's 6.5, 10.7, 12.2. First 8 months, average is going up 5% a year. The last 4 months, average is going up 12.2% of the year, or 12.2% per year. And the interesting thing is, when I looked at Nike on a regular chart, and I looked back at September last year, it had a horrible September last year. And if you look at the year before, it had a horrible September. So what we're looking at, it's had the best return over the last 20 years, and the last 2 years have been horrific. I mean, both years look like 10 to 20% declines. So I thought, wow, if we drag this seasonality chart back a little ways, I want you to watch the 4.4%. Maybe I can make this a little bigger. All right, maybe you can see that a little better. Watch this 4.4% and the 68% as I drag this back. 4.5, whoops. Hold on one sec. Market just opened. I'm going to go through relative charts of the sectors in just 1 minute, then we'll wrap this up. So there jumps to 4.5 and 70. I'll go one at a time. 5.6 and 75. 5.9, 75. 5.3, 75. 5.9, 75. 6%, 75. 6.1%, 75. 7.1%, 80. And 7.6%, 80. So the 20 years from 1995 to 2014, of those 20 years, September went up 16 years. And the Nike averaged going up 7.6% during those 20 years. That's just September return alone. And so we fast forward again. So the last 2 years have been bad, but historically, Nike has been crazy good. So I don't know if the last 2 years were just an aberration. Maybe it's a new pattern developing. I don't know why it would, but maybe it is. Anyhow, Nike is a stock to watch as we go into September, because we've been trying to hold on to this 103 area. Actually, looks like some support maybe around 102.50, the big gap up we saw in December from last year. We've been holding that. So it just seems like Nike's at a pretty good area of support. And perhaps we'll get an opportunity if you're somebody who likes seasonality, maybe likes stocks that aren't performing as well, because this is a stock that's down in 2023. Market's had a huge run. Nike's down. But if you think the company's great and it's due to run, maybe the fourth quarter, which historically is its best, starting actually in September, maybe we'll get that run this year in Nike. I don't know. But I think that's always a very interesting seasonality chart. All right, last thing I'm going to go through pretty quickly. This is one reason why, personally, I am not concerned about the market at all, and why I believe we'll go right back up to all-time highs. I don't know if it's going to happen in August and September, and I've talked about this period plenty on my shows to members. July 17th to September 26th, people talk about go away in May, hogwash. I mean, the main reason that the go away in May works is because July 17th to September 26th is weak historically. And so that brings down the May to October returns that the go away in May people look at. Yeah, I mean, that period is a lot worse than the other 6 months, but it's primarily because of July 17th to September 26th. This is the true go away period. Or, fly and I don't know, I have to come up with something. fly in July, go fly in July. I don't know. But anyway, this is the period where the market tends to struggle. Notice technology in the middle of July was at a 52-week and an all-time high, multi-year, all-time relative high to the S&P 500. We've had a pullback. What happens during pullbacks? Aggressive stocks get hit. So we're seeing a little bit of a pullback here. The overall uptrend, in my view, is still very bullish. That relative PPO is still above 2. That is strong relative strength over an extended period. Could we go? I mean, I don't believe we're going to see this PPO on the XLK go negative. I think we might drift a little bit lower, especially if we sideways consolidate for a while. But I think technology remains very strong. Let's go through these others. Consumer discretionary, still in a very nice uptrend, well above its 20-week moving average, which is above the 50-week moving average. Beautiful setup. PPO still sitting about 1.5. Looks very strong to me. But again, since maybe the second week in July, we've seen a little bit of relative weakness as the overall market has pulled back a bit. Communication services still setting new highs relative to the S&P 500. Nothing wrong here. Industrials coming off the lows from back in May. One of the things that's helped this market not fall apart too much and why the S&P 500 is not down that much from the recent high is that as we've seen profit taking in technology, we've seen other areas like industrials pick up. And so industrials now moving up. I just showed you communication services still moving to new highs. So these are aggressive groups that are still seeing more than their fair share of money that's helping their relative strength lines. Financials were good, although they've started to roll back over. And when you look at the 20 and the 50, this configuration still needs some work. So financials are probably the area that I think still need work. I think they'll do better in the fourth quarter, but from now until then, we'll wait and see. How about the defensive groups? Let me just say this, if we're going to go down, the last folks to hear about it are not the big Wall Street firms. The big Wall Street firms will begin positioning their money into defensive areas long before you and I know what's happening, unless we're paying attention to those charts. When we topped, I've had members ask, and a lot of you have asked, why, couldn't this be like the end of 2021? And we're rolling over and we're getting ready to take a big dive to the downside. And the first thing I would say is anything can happen. So could it happen? Absolutely. It could happen. I look at all my signs to try to figure out what chance do I really believe that it's going to go down? Because that's going to impact how I set up my portfolios, how I trade, how much room I want to give on stops. All of those things come into play based on signals that I'm seeing, not just whether the S&P is going up or down. Hopefully over these last 4 years, if you have followed our work at Earnings Beats, you realize it's not all about what's going on the S&P 500 chart. It's about what's going on in the overall market. So we need to watch and see what's going on in these defensive areas, because if we're starting to take off in the defensive groups on a relative basis, not necessarily when the market's going down, because that always happens. When the market goes down, we usually see more profit taking in areas that have gone up, which are technology, consumer discretionary, communication services, those areas, the semiconductors, the internet, retailers, automobiles, all of those types of groups tend to get hit when we go through a period of profit taking. So it's more about groups falling, like, financials topped in December of 2019 before we had the pandemic. I don't know if you could really use that, because I think the pandemic was, first of all, I don't know anyone knew anything about it in early December. First reported case, I think, was at the end of December. So maybe that's a bad example. But if you look back, if I go back and I show you technology, look what was happening to technology. We actually had topped at the end of November of 2021. And as the S&P 500 had a big month in December, still had a really nice month, money rotated out of technology while the market was going higher. That is a problem. Same goes for consumer discretionary. We topped in November. By the time the market topped in January, look at the relative weakness that took place in consumer discretionary. Communication services had topped well earlier in 2021, probably from, well, definitely from September. Look at the money rotating out of these groups. The top three aggressive groups, all were moving lower as the S&P was putting in its final top. That is the difference between then and now, not to mention weekly negative divergences, the volatility index, which was beginning to spike and was showing us movement to the upside while the S&P was going up. That's a warning sign. We had really a lot of short-term and long-term warning signs back then. We're not seeing that now. I'm not seeing it. I mean, I think those who are in the perma bear camp are looking for anything to grasp a hold of, which is fine. You know, I show what I do in my work, and this is what I do. Anyway, industrials, you can see making their move back to the upside. Financials, talked about that. Look at healthcare. So healthcare is one of those groups that has absolutely moved to the upside since July. So once we started seeing selling in technology, selling in consumer discretionary, some profit taking, we saw this defensive group move back to the upside. If you look at consumer staples have hardly even bounced off their bottom. I mean, this group should be absolutely soaring. Look what happened at the bottom in 2021, or the top of the market in 2021, early 2022. Look at the money that was already rotating into consumer staples. Do you see that right now? Do you see money pouring into consumer staples? Because if you do, you're looking at a chart different than the one I'm looking at. So consumer staples are doing nothing. What about real estate? Real estate, this one actually went down a little bit in early 2022, but it was seeing a lot of money pouring into it as the market was struggling, or excuse me, again, as the market was setting that last high. We saw real estate leading that move to the upside and eventually broke out to new highs. What are you seeing now? All right, do you see Wall Street getting defensive? Again, if you are, or if you do, send me a note. Let me know how, because I don't see it. Utilities, a new low. So let me just ask you this question. Is Wall Street getting defensive? You know, of course, I can't hear your voices, but I'm hearing crickets because probably that's what probably most of you are silent on the other side. There's no reason. Anyway, I'm way over today. I apologize, but you know, these are the questions that I keep getting, and I really wanted to spend some time going over this. The signals are different, folks. This is not the end of 2021. I'm sorry, but I just don't see any of it. Look at I'll show you one last chart, and then we'll take a quick look at the market and see what's going on. Look at the weekly chart on the S&P 500, and look at the weekly PPO right here. Here at the end of 2021, what was the weekly PPO doing? Going down for months leading into the end. We had a terrible negative divergence as we kept going higher. Here, at the most recent high, as we were going higher, the PPO is at a high. So I think, and this is what I've said, worst case scenario, if we continue to be weak now through September, I think we could hit the 20-week moving average, which for the S&P is 43.41. That would be another 2.75% maybe from where we are right now. And we'll see whether or not that happens. But anyway, let's see what the market's doing. I know looked like we're going to get off to a rough start. Yeah, we're seeing a little bit of weakness. Dow, S&P, NASDAQ, all down about 0.5%. NASDAQ just a little bit lower than that. Small caps and mid caps taking it on the chin a little harder. Again, Groundhog Day. This is what I've been seeing almost every day. And then after the morning session, it seems like small caps start to make ground up against the larger cap areas of the market. But we'll see what happens today. Anyway, did go a little bit longer. I apologize for it being so long today, but I did really want to go through and talk about those sectors and dispel some of the reasons that are floating around out there that, you know, we're going higher and so forth. There's another side to this argument. and mine says we may go a little bit lower, although, again, short term, very difficult to say. I would not be surprised to see a big rally, especially if that 10-year Treasury yield starts to work lower. But worst case, watch those rising 20-week EMAs. Anyway, everybody have a great day and happy trading.